Good afternoon, everyone. Captain Lane speaking, and wishing you a safe travels to your crypto destination. For those of you traveling with mice, please securely position your cursor over the light button below and right-click with your favorite finger. For those with touchscreen devices, we ask that you gently press the
Greetings to the crypto community. We are pseudo-anonymous. We are here to smash that like button. We believe this content needs to reach more people like you. We are watching. We are listening. Most importantly, we are liking and subscribing. We are pseudo-anonymous. Expect us.
Hey, Kimmy, baby, I had a book over here in this drawer. You seen it?
You mean a little black book? Oh, honey, I cleaned out those drawers in that whole room and made a big donation to Goodwill. But don't worry, we can get you another one.
Oh, hell no. You're never going to believe what happened to me today at the Goodwill. I found a book of seed phrases, honey. I can get those hair transplants now. Oh.
Go best friend. That's my best friend. Go best friend. That's my best friend. That's my best friend. Go best friend.
Check, check, 1 2 1 2.
Go best friend. That's my best friend. That's my best friend.
Ladies and gentlemen,
across the channel, it's probably because somebody hit that like button before. And for those of you who hit that like button, comment, subscribe, I just want to say thank you. Thank you very much. Well, it's all right now because anything you do, well, that's all right. Oh, baby, that's all right.
Some call him the Nostradamus of crypto. His charting skills have discovered new entire galaxies. He once was engaged to Satoshi Nakamoto's oldest.
For those of you out there that have been hitting that like button, I just want to say thank you. Thank you very much.
that sounds familiar. Here I am streaming to Zero. Hello, Zero. How's it going, everybody? Apparently you'll be watching this later than watching this live, if you watch it at all. And for that, welcome. Today we're going to kind of take a look at a few little ideas. Last time we kind of got in depth on some Fibonacci A equals BC targets and all that kind of stuff, and give you some stuff to digest there. A little time for that. This time I thought I would just cover a few little basics here. And volume, triggers, and signals, and probably kind of emphasizing what led me here was entry, how to enter a trade, when to enter a trade, the little combination of things that you need to have in order to say, hey man, this one's worth taking. A few of the things. There's several things that match up. Your risk reward ratio is a big one. If the trade's not worth taking, if the target that you can hit is not worth a good return, like 2 or 3 times the little amount that you're risking, that you would be stopped out. So if you set your stop loss where you're only going to lose $100, well, you would want to, at least on whatever trade that you got, be able to make 200 or 300 from that. That should be your goal. Preferably 300 or 400 from risking that $100 there. I don't have any way to diagram that, but we talked about that before. We'll probably talk about that again. That's an important part to keep in mind. But the volume. Let's take a look at volume. See Glitter. I see Ryan K out there. How's it going? Watching you in the hockey playoffs. Glad to have you here. Volume is a critical factor of trading as it indicates the strength, the liquidity, and reliability of price movements. And why does that matter? Well, it can help you confirm price trends. We want to pay attention to volume. Let me turn down the music here just a little bit. Turn you down a wee bit. High volume during a price move signals a strong conviction. So if we do see something breaking out, like we see Bitcoin getting above this little line, some people might see that as a breakout. Here we got a trend line or a line. Definitely some people might see that as being a breakout. Any volume behind that move? I mean, wow, over here you definitely see some behind my turkey head. You see a little flux of volume coming in here, and then this nicer little run right here. And I don't know if you can see that. Yeah, I think you can see the candle. The one that comes all the way up to this area. Those are the volume spikes. That's when volume's coming in. And we look at that during a breakout to kind of, hey man, is this one going to be a good one? Is this one going to stick? So that's a good thing to pay attention to when you're getting a breakout. If you see low volume, then there's not much move behind it, organic, like I gotta get it, I'm pushing, I gotta hit the buy button, Helen, we got to buy now. That's what you want to see. That's what you want to see when you have volume behind a move, man. There's a lot of these orders coming in, and there's a demand. There's a demand for what's being sold at that price, which takes price higher. But here, I mean, where we just broke out of, I mean, that's a little bit for what it was doing before, but there's no volume there. Not like what we saw anywhere else. It's nice to look at. But just one of the ideas to consider there. Alter that trend line. Don't want it to make it feel excluded there. So volume is kind of important. It measures liquidity. Higher volume means more market participants, improving liquidity. This reduces the spread and the slippage. Have you guys been playing around with like Coinbase? You ever notice how you pay more there than you do anywhere else for stuff? In some of these decentralized exchanges, slippage is a problem. Places like Crypto.com, also slippage is an issue there. It's part of how they make their money. With that slippage. But otherwise, technically what slippage is, you have a buyer at one price willing to pay something, and you got a seller over here, and there's that little gap. And if you market buy, that's where the slippage comes in. The market buy will take you up to just to buy the next highest order, and there's a gap between where the lowest lower order is. That's where the market makers come in to kind of help even that stuff out. They're a necessary evil. Volume also identifies reversals or breakouts. Ooh, that sounds juicy. That sounds like a great reason to like volume, right? Spikes in volume often precede significant price changes, such as breakouts from consolidation patterns or reversals. Key support areas. That's where we usually find ourselves. We usually find ourselves in the consolidation where it goes rangy and you're like, what the hell? Because we just came off of a good move, which usually comes from a reversal or a breakout from these little sideways areas. And when you see some volume that precede those, or happening there, breakouts from consolidations with some volumes behind them, that's a good sign. This volume can also validate patterns for you pattern traders out there looking for that little flag to the upside, that head and shoulders, your triangles. It's a lot more reliable when it's accompanied by high volume. such as I think all this stuff kind of reiterates what we just looked over here. You know, you're looking at this as being a pattern. Some people will squeeze the tip there and look for, you know, the smaller idea, or just follow your basic trend lines, and sometimes that kind of happens naturally. I hate it. The product's getting squeezed there, and again, looking for the volume of that breakout. Trying to look for any other examples over here that we could have. Any breakout will do ya. Any break of a trend line. I mean, that's basically what you're looking for. With any pattern, you got a top trend line pattern. Oh my God, are you going to be the old guy that draws that pattern again? Oh gosh, don't do it. I find myself doing that now too. I don't know. It's just looking at the trend lines is basically all it's doing. But breaking above that, it had some growing volume, but it wasn't the great. It wasn't the like this was great. Well, that was good. That one showed up. That one showed up. However you want to look at that. I mean, that's what we would have started with, something like that along those lines. But seeing volume wherever you want to put your little line in the sand for the breakout, the volume kicking in, that one definitely had an effect there. This is what they call backtesting ideas, where you just go back and look at the previous ideas. I'm in the smallest time frame here, which will also affect your volume. You'll see the biggest volumes, the most important volumes on the bigger time frames. And so with this breakout for Bitcoin we got, there was some decent volume there. I mean, it wasn't flat like it was through here. Definitely coming off the bottoms there, the volume. There's other ways to look at volume too, and other indicators that do it. That do I still have you on here? This little guy is a visual range volume profile. Currently, what are you saying, baby? Since let's take a look at you. Let's see what you're saying as far as volume goes here on Bitcoin. Let me get I'm trying to get a yeah. This is a blank chart. Yeah. So by this, well, you changed, and that's the annoying thing about this one. It takes the visible range. So to alter this, you scale out or scale, and it just goes by whatever's on the screen. So you can get some confusing results if you don't realize that. It might throw you off. And with this, these are called nodes, and that's a node, and this is the point of control. And what are you saying, man? What area is that? I don't have you turned on. 96,500 is kind of this big area that we could go into and get rejected off of, and that's one way to also look at volume, because there'll be a lot of volume of selling going on right there, shorting, that kind of thing. Let's get back to our little volume thing over here. It signals institutional activity. Large volume surges often reflect institutional buying or selling, which can drive sustained price movements. A lot more buys than bigger buys. Make a number go up, up, up. Volume-based indicators, tools like on-balance volume, OBV, volume-weighted average price, the VWAP, accumulation distribution, rely on volume to provide insights in the market sentiment and provide price direction. It's like the tools that we just looked at. The caveats: volume alone isn't enough. You can't just use it by itself in a vacuum. You just add that. That's your little sidekick right there, whispering in your ear. Man, I think it's a good thing. No, I don't know. I don't really see what I need to see to make you think it's going to stick. You know, it's that little confirmation thing that you got going on there. It should be analyzed with price action, take into account your support resistance theories, your areas. Make sure you're identifying those. You're bouncing off one of those or at one of those areas. That's definitely when you want to pay attention to all the other little signs and other indicators. In some markets, such as Forex, foreign exchange, volume data may be less centralized, requiring alternative metrics like tick volume. In short, volume is a key gauge of market conviction and liquidity, helping traders assess the validity of price moves and make informed decisions. Always combine it with other analysis for context. We're just trying to assemble in a little round table here, the smartest people, the smartest indicators, the smartest tools, and we're going to listen to what they tell us. And at certain times, especially at breakouts, we take a listen, take a gander. That kind of leads us into our next little topic here. Welcome, 5 people. Glad you're here. I see Avi Medina, Roguelide, Glittery Marshmallow, Ryan K, and did I miss anybody? Avi Medina, Roguelide, Ryan K, Plokies Angels, Glittery Marshmallow. Okay. Glad you guys are here. Triggers. Triggers in trading are specific events. They are conditions or signals that prompt a trader to enter or exit a trade. Their significance lies in their role as actionable decision points within a trading strategy. You need a trigger. That trigger is going to be why you take action to get in a trade. Now, for me, I mentioned this one a lot, especially when it comes to a breakout trade, like crossing the trend line, no matter what we're on. When we break across there, where's my moving averages, though? I'm looking for a break, and I'm also looking for price to get above a 9 moving average. That's usually, now on this one, we were below, usually get above the 9 moving average early on, and honestly, I wouldn't have been. Me, I like to look for, this would be the most ideal explanation of when I would use it when we get above the 9. Helps me on smaller time frames and whatever, but if I'm doing a breakout, I'm looking for that. Now for this bigger one, we've been above the 9, but is there any other signal that we could use? Let me get that volume weighted profile up in there. Is there any other signal now on this big trend line? Is there anything? We're already above the 9, mile lost or whatever. That 200, play it as I'd play the 9 on this one. If we can get above the 200 and hold it after we break through a trend line, that's good. That's a good, even if I wasn't in the trade, I would take that as okay, that's a trigger. Bouncing off of that, that's a trigger. Some people have other things for their trigger. Maybe they'll wait for a candle body to open or close. If you get more conservative, you can do that. The only thing is that you can miss a good part of the move if you get too conservative. There's you got to have the conviction to take your trades, and then again, some people are playing levels and waiting for levels to be met. Those and I guess treating those as a trigger or signal for them. That in theory, what you're trying to do is catch an uptrend and make sure you're on it. But buying them right when they get above those levels, it's usually your next higher low you want to look for in a condition like that. Otherwise, you can buy. They can fake you out. Yeah, they likes to come up just a little bit and then come all the way back down. So that higher low is the one to look for, in my personal opinion. This one's lucky enough that it came out right about even, retesting that W pattern there. Let's come back to our little trigger thing. So triggers define entry and exit points. Triggers provide clear, predefined criteria, such as price crossing a moving average, breakout above resistance, or RSI reaching over bought levels to act on, reducing emotional or impulsive decisions. So RSI, now that's getting into our indicators over here, and they're good. In fact, if I can, we'll come over here and talk about RSI for a minute. So the rules with RSI, and the same things that we program our bots to do and things like that, is that when it gets above the 30, that's a buy signal. Down through here can be some of the most juicy buys when she's below 30 and starting to turn around and showing them first little signs there. Also use RSI for divergence when we see, that it goes contrary to price action. Like if this is rising but price is actually coming down, then we know we got a nice divergence that could give us a nice move in the opposite direction there, a reversal. But there's one thing that I do like about this when you do combine some indicators and with some of these ideas. Let's say that you've also got the stochastics, which is a very similar indicator, but they have a lot more movement up and stuff like that. Let's go ahead and get you over here. if you find a bigger time frame, I want to throw this. This is a little gem for you guys, the 7 of you guys here right now. This is, some of you may know it, some of you may not have a clue, but this could be life changing, especially on the weekly. This can help you nail the bottoms, especially on the weekly, daily, 4 hour. When you see this happen, these are usually a bottom. This is usually one of the best places to get in when you're looking for this and find this. Is when your stochastics RSI. Can we not do a vertical thing here, man? All right, I thought I could do a line. When they bottom out at the same time that your RSI bottoms out, beautiful. Backtest that idea, you will see that those are the most beautiful bottoms to get in the market, especially on the weekly and the daily. Go look at the all-time. Go look at all the bottoms. In those places, man, I wish I nailed it. Those are the things that will help you figure that out. Those two things right there, if I can say. Same thing for the tops. When you see, when you see us going above 70, we come up. I mean, this thing can go all the way up to 100, and you don't know. But I like the new RSIs because they start tinting them green and everything when they start getting oversold and all that kind of stuff. And so, if you come across a situation where you're oversold, so that overbought, I still get those confused sometimes. You're way overbought here in RSI and also on your stochastics, and you know the stochastics may also look something like this. Sometimes they can get pinned up there, but then they start coming down. If you see them starting to coming down, they do like that, you know. Yeah, that will help you. That will help you time those things a lot better, especially on the bigger time frame. It works on every time frame. Try it out. But those are two nice little things. Since I started using the market cipher indicator, it's hard for me to see them as clearly with the stochastics. And I couldn't do it at all with the RSI on Market Cipher, so that's why I have this RSI, just the traditional RSI, and then I can kind of get a good feel for the stochastics over here on our Market Cipher. So I use these little guys, and then my RSI. Might we have an example of this that we can talk about? Yeah. Can I line you? Why my vertical line quit working on me? Say it's not so vertical line. Why? I have no more vertical lines. Well, that sucks. All right, so that's when she came down to 74,000. And if we can see that, that's right before the RSI started coming up. She was down. Now VWAP, that could be a little idea too. VWAP is actually working its way up, if that's what that is. That little yellow line was coming up while all this stuff was down. That was very nice too. But stochastics was down, and then she started coming up. Right? They were both bottomed. They were both bottomed out at the same time. Right? Price and the RSI. So when they were both bottomed out there, deep in the red on the RSI too, that was one of the best places to buy. Over here, I think that's when we got our higher. We got a higher high on that. That's when we got our lower, or our higher low. We got our lower low here, and that actually made the divergence, and that was even better. It didn't get any lower. But that was also showing that there's going to be some good uppiness coming there, and that's also, I believe, yeah, right here, right when we had the dip here with the RSI stochastics flipped on us. Just some interesting things there to share. Ryan K says, is VWAP part of the market cipher B, or how do you read it? Now, it's called, on the indicator itself, that's what it's identified as. And Crypto Face just laughs about it, so that's not really VWAP, ha ha ha, but he won't ever tell anything what it is. It's not the traditional VWAP, so I don't know, but that's what it's called, that's what it's labeled at, and it was on here, right? I'm looking in the, I might be on the wrong thing. Money flow, wave table, blah, 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 blah. Maybe go over here to style. Just making sure that I'm correct here. Well, you're not even saying. Buddhist to purchase, marriage, VWAP, yeah. So it is labeled as VWAP, but it's not the normal VWAP. Usually the VWAP, when you turn it on, it's volume weighted average price, and it's a line that'll kind of follow price, or you can do anchored VWAPs, and it calculates it's based on where the low or high or whatever you got on. It's different, so I don't know, but it's labeled that, so that's what I call it. Go Bitcoin. Do your thing up there above the 800 moving average, Bitcoin. Let's come back to our little thing over here. So triggers again, that's what we're talking about. Those little events that will help us figure out if we're going to enter a trade or not. We just talked about the one I use a lot, breaking a trend line, support resistance area, and getting above the 9 moving average. I use that a lot. And we talked about the instance of 200 moving average that can be used. It enhances your discipline by relying on triggers. Traders stick to their strategy, minimizing hesitation or second guessing. This is crucial for consistency. Now, there is one trader out there. Now, they're real big on the 200 moving average, but if they're doing like a little flag or something like that, they have no trigger, man. It's just like, oh, there's a pattern. Let's jump in. Not even waiting for a breakout. Now, usually people are waiting for a breakout as being a trigger to get into a pattern, right? But I mean, there's a few of them out there. I'm just saying, without mentioning any names, that you know, you can see when it comes to a pattern or something, they're just in whenever. There's no trigger. I hear them talking about coming to the 21, but they're not very definitive on that kind of stuff. But a trigger, on every trade, you need a trigger. It's something that tells you, yeah, jump in now. And that can be volume. It can be your indicators. But relying on them, it helps you stick to your strategy, minimizes your hesitation, and rule out this second guessing, helps you control that. And that's crucial for consistency, especially when the markets are volatile and shaky, kind of like they are now. So triggers also signal market opportunities. Triggers often align with technical, fundamental, or sentiment-based events, such as candlestick patterns, earnings reports, volume spikes, and it helps traders to capture potential price moves. Got a lot of this going on right now everywhere. We got earning reports coming out on Google. I think they did better than expected, like 40-50% better or something like that. That's what I heard. So, and the market's got a lot of that on the regular side going on, and on crypto we got our headaches and everything too. Plus we got to deal with whatever they're dealing with, because they're the big money in the market. When they decide to get scared and sell out, this used to be the first thing that they sold to get out of. That's why we were the first to dump a lot of times last cycle. I'm telling you, institutions are paper-handed little SOBs, man. Little mama's baby. Big money. Oh my God. the smallest little China man Bitcoin. I sell it all. Anyway. Support automation in algorithmic or automated trading. Triggers are coded conditions. Yes. Example, a stochastic crossover or a news-based sentiment shift that executes trades instantly, leveraging speed and precision. And so, like your bots, you know, you have little signals and triggers for them to tell them when to get in and for the strategy. So it's not just you and me. You also got all the bots out there, and that's mostly bots. You got to be smarter and better than a bot. That's all I'm saying. But yeah, and you can be. Swing trading, baby. Swing trading. That's what's made for us. That's really what most of you guys really should be focusing on, in my personal opinion. That and maybe some midterm holds and things. Not saying you can't day trade and have fun trade and, you know, small swings trade. Do all that too. But your biggest thing needs to be mostly your swing trades and long-term holds. for the little short term we got left in this market here to ride those babies up and go for those bigger moves. Scalping probably ain't going to do it. The gurus that scalp with the big move we have from Bitcoin from 78,000 to 90-something thousand right now, a lot of them did not double that account in that move, and you know they could have. It's probably not up very much. So imagine you're going to spend your whole cycle just to make a few $1,000s on some little $1,000 account, or a few $1,000 account. Not, I don't know. I mean, scalpers have it rough, and day traders have it rough. They spend a lot of time on these screens. Sometimes they get it big, but a lot of times there's a lot of break even, or if that at all. It's more risky, ladies and gentlemen. But the swing trades are pretty forgiving, especially in the right part of the market, and we kind of are. I'm getting off topic, but risk management triggers like stop loss or take profit levels help manage risk by automatically executing or exiting trades when predefined thresholds are hit, like protecting capital. Triggers. In that aspect, that's kind of like me with the 9 moving average. If we lose it, that could be your first signal to take profit, especially if it's on a bigger time frame. Smaller ones will have you just doing things in and out or whatever. The trend line. You got multiple trend lines. You got your base trend line, your overall trend line, then you got a secondary and third, and sometimes even a fourth, spring off of those, right? Usually you get about 3. Sometimes, I guess it depends on how far you want to zoom in. But you got a trend line, and when it breaks, that's a trigger. That's a trigger that, hey man, I either need to cut this trade or manage my risk, maybe sell a part of it to see what happens. They don't always, especially in a bull market, come down right when they break a trend line. Sometimes they might go up a little bit before they start their downward move, especially in a bull market. And sometimes they just need to come back, and then they'll go on a bigger trajectory or retouch an old trend line. But that trigger of even having a stop loss underneath there will save you from having to go through whatever's here, and then you can find a better entry or add to your position and things like that. So to me, trend lines and moving averages and even maybe support levels. We lost a horizontal support level, lost a Fibonacci area, that would concern me. And it could be a trigger for me to sell off a little bit or de-risk, or if we hit a certain area to take profit. Let's go back over and take a look at the key considerations here. Reliability triggers are only as good as the strategy behind them. False signals, for example, breakouts that they fake out. The breakout is the fake out, that the reverse. Those can occur. So confirmation from volume, trend context, or other indicators is needed. And that's why the volume will help you identify those little breakouts that aren't real. If there's not much going on at the breakout, volume-wise, there's more than likely. I look at it this way: the market makers are just backing up on is it the bid ask, and then forcing people to bid up, while they're also helping to force people to bid up. They're putting bids lower than what other people are putting bids, just to kind of push people forward. They're pushing the market that way. It's not authentic volume, therefore it's not there. And so when you see price rise and volume falls, that's also a good indicator that, hey man, this move is probably not going to hang around on these levels too much longer. There's not enough there to sustain it organically. But for a breakout, definitely it's more helpful if you see that volume. Otherwise, it may go, look, this breakout, consider that a breakout, and it just went sideways. It didn't have this was volume. I mean, it was sell volume, but still, you can see volume bars there. But at this breakout, it's kind of, it's something. And you got, that's something response. Boring breakout. All right, so context matters. A trigger, we're talking about triggers right now. A trigger's significance depends on market conditions. For example, a moving average crossover may be less effective in choppy markets than in a trending one. I didn't talk about the possibility of the moving average crossovers being a possible trigger. Sometimes they are for me, or sometimes maybe to add to a position or something like that. Sometimes, not the biggest thing, but sometimes I might. If I see two big moving averages getting ready to cross, I might start looking at it or look at the next dip that they come back to try to add, or maybe a little bit of both. Because usually, that would be a nice, especially the smaller moving averages getting ready to cross. Yeah, now I might actually, that would be more probable for me to add something in. Let's say if I was on the 15-minute and I don't have a good instance down here because they're already crossed. The 50 is crossing over the 200. I'd wait for a pullback on that one. But let's say if the 9 was just getting ready to cross, like here or something, I would be thinking about it. If it's crossing like it was over here or over some bigger moving averages, I would think about it. Maybe, but not. It could also screw up my position, throw my trade off. So I don't want to just do that willy-nilly. I would take it into consideration. Over-optimization risk. Overly complex or over-fitted triggers may work well in back tests but fail in live markets. So don't want to make your trigger too complex, and definitely don't want to have some 10-step checklist to go down. Should I is this it? I gotta check this box and this. That's one of the things when I had a bot that like, why does this bot never buy or sell anything? It's because, well, I had too many triggers. It was rare for all those triggers to combine at one time, and I'm like, oh, that's why I'm not making any money. There's nothing that doesn't fit those two perfect qualifications. I had to lighten up a little bit, and it gives them more room to work with. So too many rules can hurt you, so don't have too many rules. You want the simple, effective ones. Examples of triggers: technical ones, bright price breaking above a trend line, a MACD crossover. We talk about that a lot, especially on the weekly time frame. That's one you really need to pay attention to. Or Bollinger Band squeeze. Woo, I got the crazy. Fundamental would be earning beats, economic data releases, or central bank announcements. Volume base would be a surge in volume confirming a breakout as a trigger. Time base, entering a trade at market open before a major event. If you haven't noticed, your crypto morning gurus that get such the rep, they are coming in at the perfect time for any kind of pump or price action between 10 a.m. to about up to about 1. 10 to 12 is the sweet spot. So just know that, like, if you come across one that's it's like price moves every time I'm here, I'm magic. I feel bad for the people that they're duping there. So, oh my God, so he does know. No, he's just taking advantage and monetizing that on the backs of his people. That's when a lot of your day traders come in pre-market for regular markets. They come in, I think, about 9 o'clock. Even pre-traders, even there's trading going on before that. If you're in the elite, that'll change over here. Everything's going to be tokenized. They'll probably still have some kind of weird ass rules though for some people. This song gets on my nerves. There we go. All right, so in summary, triggers are highly significant in trading as they provide structure, discipline, and clarity for executing strategies. However, their effectiveness depends on robust testing, market context, and integration with other tools like volume or your risk management. Always validate triggers within broader market analysis framework. So triggers tell you they're the event, the thing that you got to develop for yourself. You got to come up with your own. But it's that thing that tells you, yeah, this is the point to get in the trade, or this is where I need to enter, or this is why and when I need to enter. That's why you need a trigger. Your triggers. All right, now we're going to talk about signals. Now, you would think that maybe they're the same thing, right? But they're not really. Signals in trading are specific indicators or patterns or events that suggest potential opportunities to enter a trade. They're closely related to triggers, but focus more on identifying possibilities, while triggers are the actionable conditions for execution. So there is a difference there. The significance in trading is substantial as they guide decision making and strategy implementation. Here, says Grok, because Grok is cool and he's cheaper than $99 a month. I'm telling you, you get better education on Grok than you will some of these trading groups. Here's the concise breakdown. Identify opportunities. Signals highlight potential market movements, such as trend reversals. I like that. Breakouts. I like that too. Or momentum shifts. Based on a technical, fundamental, or sentiment analysis, for example, a bullish engulfing candlestick, a strong earnings report, or sentiment shift on X-Post. Signals serve as the foundation for trading decisions. They help traders align actions with their strategy. For example, a moving average crossover might signal a trend change, prompting further analysis or a trigger to trade. He owed moving averages. Yeah, darling. Kind of like what we're seeing here on this big 4 hour when I get my big girls out, big boys out here. 800, 600, 300. Apparently, we did not get rejected at the 800. We're trying to hold it. Now, that's bullish. Doesn't mean she ain't coming back down here, though, okay? Doesn't mean she ain't coming back down here. But that's great. You can get above those. Know that there's a little area that they can, but then they kind of snap back down to these guys. Just knowing that and seeing that they are still in a bearish predicament lets me know not to get too happy, get too bullish, and especially not to be chasing the prices when they're up here, but to be patient and wait for them to come back down or take advantage of when they do come back down with any possible short ideas. It lets me know that I should also probably take some profit up here and buy cheaper. Same as a short idea, just on spot. That's the advantages of some moving averages there. Signaling a trend change. Usually the crosses of them and things like that will help you with the trend change or the ribbon flipping. We can get into that. We've gotten into that before. The reduced subjectivity signals by providing objective criteria. Signals help traders avoid emotional or haphazard decisions, fostering consistency and discipline. Signals enable automation. In algorithmic trading, signals, RSI hitting oversold levels, or a news-based keyword trigger are coded into system to automate trade identification and execution. Use that in the bots. They would also act as a trigger and a signal. Or they would take the signals and then you make it act as a trigger to enter or exit a trade. Such as the 200 moving average is why I actually know something about that. There's some advocates here on using it on the daily. Now they're starting to smarten up and starting to see what's really going on, or the 1 minute. You have a 200 moving average. And it's true on anything with a 200 moving average. When you get above it, you're bullish, and when you're below it, you're technically bearish. That's how a moving average, 200 moving average works. That's our baseline, right? We're going to do our little moving average stuff right here. Where were we? Oh my God! Did you lose your train of thought? The thing about it is that if you do it all in one time frame, I mean, in a choppy market, you're not making anything. If you get lucky and it's at a bottom and going to a top, or going on a run, you might get a little bit. It's going to chop you up. You're going to be in and out, in and out, in and out. Now this person that was doing this, and just I don't know, is their main thing. Now is just starting to see, oh man, I can enter on a 1 minute, but then I can exit like on a 5 minute. You think? And that's where you can use some of the same strategies with time frames. So, or is it better just to play it on the 5 minute? The more you go up in time with these things, the more movement you get above these moving averages, right? The more time you get to spend in an actual trend and not in so much chop. But the more tighter or smaller time frame you go down to, the more chop there is, and the more you will get chopped up with some of these moving average strategies. Unless you just want to be that little scalper trying to catch every little moving average move. Ooh, there's a whole 99%, and that was a good one, because that's usually not what happens, right? Look, you got above it here, got below it here, got above it here, got below it here, got above it here, got below it there, got above it here. You be chewed up, nothing, even giving all your money back in fees trying to apply that strategy here. So you can't say that every time you get above the 200, it's time to go in. No, you need to zoom the freak out. And then time that with what is going on over here. Like, oh, this is a good place to start looking at that idea. This is a good place at these dips and things. And those are good places to start looking at maybe trying to catch something around there. But just immediately go to the 1 minute and just, there's the 200. It's proven not to be the most best strat. I mean, you break even or do a little bit best at best, and I think that's what I see with that account value too. It seems that nothing has changed. We're getting off on a little tangent here. Support risk management signals can indicate when to tighten stop losses, tighten your stops, take profits, and avoid trades altogether. For example, divergence signal warning of weakening momentum. You start seeing some bearish divergence in your RSI. That's something to make you think. You start seeing what would be a cross of the 9-moving average or the MACD on the weekly or approaching that on the daily 4-hour. Make you think about whether you want to go longer there. I might want to slow it up and take a look. Key considerations: false signals. Not all signals are reliable. Whipsaws or noise in choppy markets can produce misleading signals. Wonder why you keep getting stopped out in the chop because you can't trust your signals as much in the chop. Remember that 200 moving average strategy we just talked about in the chop, how it went, it sucked. Yep. Requiring confirmation from volume, price action, and other indicators. Context dependency. A signal significance varies by market conditions, time frame, and asset. For instance, a stochastic crossover may work better in trending markets than in range-bound ones. Yes. Overload risk. Relying on too many signals can lead to confusion or conflicting information. Prioritize high probability signals based on tested strategies. So you can't have, like I said, you want a sweet little handful of signals that you know are reliable. For me, or we went over those early, and that's basically the ones I look for all the time. And some of you, even the ones I forgot about that come up here, find the ones that present themselves that you're familiar with and comfortable with taking, that have worked for you before, you back tested, and there you go. For me, if I'm looking for a breakout trade and we're getting over a 9-moving average, that's a good signal and trigger for me. Confirmations needed. Signals often need validation. Combining MACD signal with high volume to increase liability before acting as a trigger. So here we talk about combining a lot of things together to see what we got. Have something happen at a Fibonacci area. You got something happening on the moving averages. You got something happening with the price action pattern. Maybe a trend line breaking as well. You put these little things together and all the little plus signs together. Like, hey man, that looks like a good little deal. Examples of signals: technical chart patterns, double bottoms, indicator crossovers, MACD or the EMAs, or Fibonacci retracement levels. I use them all. Fundamentals could be economic data releases, insider buying, hey Nancy, or analyst upgrades. I can think of a few analysts that need a few upgrades. Sentiment-based social media trends or unusual activity on platforms like X, signaling a retail interest. There are some bots out there that will take Twitter feeds and trade based on that stuff. Volume-based, a spike in trading volume indicating some strong buying and selling pressure. The significance relative to volume and triggers. Compared to volume, signals are less about confirming strength or liquidity and more about spotting opportunities. Volume often validates signals, making them more reliable. So a lot of things keeps coming back to the volume, and that's where actually people are jumping in and actually trading. Like there's a demand for it. Like, hey man, I heard about this. I think we should jump in now. We get more of that activity, and it's authentic price buying. It's buying because they want, not because they're enticed by a bot, a market maker, whales trying to, hey man, I'm gonna spoof this order here. Yeah, I'm going to put it right under yours and make you feel pressure. Like, oh, if you really, and I might even put one above it and keep taking it off and just kind of make you want to jump up ahead. Yeah, like you know, you have to one up me. Yeah, they could start playing all these little games to drive buyers to buy higher, all the while pulling they're dangling that carrot and just pulling it back. So, oh, come on, a little higher. Oh, here's a nibble. Come on, get a little bit higher. Getting you to chase the price. They are good at that. They're really good at that. And volume is one thing that they can't fake about it. It's the one signal that kind of exposes that, if you're looking at it, is the volume, the genuine volume there. We want to see some authentic price action, and not them just kind of pulling back and stuff. It shows up. They're good at faking it too, or doing the other, and covering it up sometimes. But a lot of times the volume will help you see it. Signals are primarily, compared to triggers, signals are preliminary. They suggest potential trades, while triggers are the specific conditions to act. For example, a signal might be a price nearing resistance. Hey man, we're getting up close to this resistance area. We might want to think about selling. That's a signal that's coming. Hey man, the MACD's getting ready to cross over. That don't look too healthy. There's some bearish divergence there on that RSI. That could be a bad sign, a signal. Oh man, dang man, that 50 moving average just crossed bearishly over the 200. That's a sell signal. So a signal might be a price near resistance, while the trigger is the breakout above it. That's the thing. That, oh whoa! You didn't get rejected there. You bounced above it. Oh, trigger. Hence, that kind of goes back to what we were talking about earlier about some people when price gets above a certain level. So people that were looking over here at this, and for this time it worked out right so far. We got above it. That's your trigger, man. It's called buying the tops or buying high and selling higher. Where some people were going to wait for the retest of something like that. But that would be a trigger for some people. And sometimes, usually when you get your higher high, you get a higher low. We talked about those ideas too. That's why I don't really. It's not my favorite thing to do. Doesn't mean I won't do it in a pinch, or if I don't have a position, I think I'll put a little in and see what happens. Instead of going all in, that way you can build a position on the ups and downs of it. In summary, signals are highly significant in trading as they pinpoint potential opportunities, enhance discipline, and support strategic decision making. However, their effectiveness hinges on proper filtering, confirmation, often with volume, and alignment with triggers and market context. Traders should test signals rigorously and integrate them into a cohesive strategy to maximize their volume. We've done this with the help of Grok, and I know I haven't really come over to the chat or anything that much, just trying to get through the little. It's worth knowing this stuff and going over all this stuff, and you may be familiar with it, or it may be something a little bit new, or some of the things here you hadn't really put them together all at once in that context. Actually, I thought Grok did such a good idea putting it together. I see no reason to have changed anything or to dig up other sources, because he really covered it. It really covered his bases there. Ray Marshmallow says, "That's cool. I did not know that." Hey, that's good. Thank you. It's an important thing, especially if you're new to the market. I mean, this is the kind of stuff that kind of takes a while to start sinking in, because you got all the other stuff, mostly dollar signs in your eyes when you're first in the market. You're ready. Screw the videos. Let's start trading. We're in the group. That's good enough. Like, there was a feeling I remember in paid trading groups, like, just getting, paying to sign up means there's this part of your brain says that automatically makes me a trader. Or maybe watching a few, being in some of the, learning a little bit, and you're like, that makes me, I'm part of a winning group. Yay, here's my $100 this month. Thank you. Yay. Oh, look, 20 setups every day that I can play. That's not going to make me accumulate a bunch of bags. Trading groups can be a wild experience. I don't know that they're all technically all that healthy, or some of the things, if they're money motivated. Anyway, Thank you, guys. It is 8:51. That's pretty decent. How long have we been going? About 54. That's about right. All right, so you guys can, if you have some suggestions or whatever you would like, topics that you would like me to cover on the next week's video or next week's stream, leave them in the comments for this one. That way I can see them. Because if they're put anywhere else, I won't see them anywhere. But if there's something or certain questions and things like that, put them there. We can address those on the next one. But thank you guys for hanging out, and I hope you guys are having a great time in the market. And I do know that Bitcoin is looking. We're coming into Friday, and so tomorrow looks like it's going to be a bullish day. If I had to take my guesses on this, on into tomorrow. Wow, you trying to actually do something? But I'm curious to see what they're going to do on over the weekend on Friday and Saturday as we start getting to some of these resistance areas there. We're at a couple. Oh, are we in one? That's an idea. My keyboard is not working right, man. Control stuff is not working anymore. Why is that? I have to figure that out. Hey, good night, everybody. Sorry, I'm getting off talking. Gotta get ready for tonight's stream. Thanks for hanging out.
Shielding through the fight. Mean coins hit fast, scams in they gleam. By my trash they blast, tore my dream. Lost my last dime, rent's knocking my door. Lights out in time, scam shook my core. News lit 'em up, jails their new stay. Flip to sat to shine, bull runs my play. Yeah, when the charts crash low and the scammers glow, ooh, you've got my back, my crypto.
My control button not working?
Smirk, girl, your stack's my game. Pumped his junk, then jerk, left me in shame. FOMO's cruelties drained my last dime. Gas fee squeeze, stalled my climb. But I held tight, flipped a dip to glow. Sats in my sight, turned the scam to woe. Markets my pulse, coins my shield of grace. Bull runs my force, scammers lose their place. Yeah, when the charts crash low